Hey everyone, how's it going? My name is Anthony Walker. I'm the Chief Investment Officer here at Cornerstone Commercial Investments. We are a real estate investment and asset management firm, particularly focused on multifamily and multifamily development and value add acquisition. Many of you guys may know me from our marketing or from LinkedIn, but stoked to have you guys all here, and we're going to jump into this presentation. Today, we're going over investing in multifamily, of course. Some FAQs we've been getting a lot, what's going on in the multifamily market, what we're currently seeing with these interest rates, with these new dynamics in 2023. So yeah, let's jump right into it. So first off, I want to start with introducing our team who we have on this panel today. We've got myself and three of us here today. So Sarah, we'll start with you.
Yeah, hey everyone. My name is Sarah Jarvis, and I am our business development and investor relations coordinator. So I'm really the investor facing. I will always walk you through kind of what it's like to invest with us, subscription documents, things like that, answer any questions as far as our current offerings or anything about working with us. And so I'm really your point person after the webinar. If you have any questions, your questions don't get asked or answered or anything like that, I am your person. My contact information will also be towards the end where you can reach out to me for anything like that.
Awesome. Thank you, Sarah. All righty, Tom.
Welcome, everybody. I'm Tom Nichols. I'm the regional general partner here in Oregon. I'm a licensed real estate broker in Oregon, as well as a developer. Been here about 30 years and built somewhere north of, I don't know, hundreds, 300 or 400 projects here in Oregon, especially in Central Oregon. So land development and construction is my forte.
Awesome. Happy to have you here. And then John.
That's me. Yeah, I'm John Nichols, John Stephen Nichols. My dad is John Sr. He'll get to know as well. I'm the COO, one of the co-founders here at Cornerstone. I'm in charge of asset management and construction for our team. So keeping everything going with our general contractors, asset managers across our portfolio and in the office.
Awesome. And again, you guys have already met me, but I'm Anthony Walker. I'm the Chief Investment Officer and also one of the owners. I'm in charge of underwriting deals, looking at deals, risk mitigation, marketing, and just growth. So we are excited to have everyone here. And again, if you guys have any questions, throw in the chat. We're going to answer all the live questions at the end. We've already got some stacked up that we've gotten leading up to the webinar, but if you have anything that comes in your mind, we'd love to answer it. All right, so got to start the presentation with a little disclosure. Of course, everything you see here is a lot of our opinions. Also, any metrics or like that are not guarantees. They're either targeted or, from online resources and what we're seeing from economists and other specialists in these realms. All righty, so today's topics and what we will be talking about. So first off, we're going to talk about the state of the multifamily. We're going to overview what we're kind of seeing, what we expect to see, and what's leading into the end of the year. The risks that investors should be aware of. We see a lot of deals out there. We see a lot of assumptions. We see a lot of targeted metrics that once you dive into one of these deals, they're really just not true. Also, the do's and don'ts that we're seeing in today's multifamily markets. We've seen a lot of articles in the Wall Street, a lot of deals go south lately, and so we want to just see, tell you what we're seeing and some of the stuff that we're trying to avoid and some of the stuff that we're adding into our deals to give our investors more protection. And then again, we're going to do that live FAQ at the end, so make sure you watch till the end. All righty, state of the multifamily market. Let's jump right in. So John's going to take these next couple slides.
Yeah, so my job at Cornerstone, like I said earlier, is to work with our asset managers. Again, we're in Idaho, Montana, and Oregon. So I work with each of the property managers in each state, working on across our portfolio to make sure we're staying full, delivering returns back to our investors on our properties that are cash flowing today. And so that's what I want to talk about. So not only are we seeing, starting with higher interest rates, we're actually, the 10-year treasury is the highest today than it has been since 2007. And so we're definitely seeing that increase, and we're feeling it. Everybody's feeling it right now. So it's definitely something we're aware of, and we're underwriting to that as well in our new developments so that our investors know, we're not trying to predict interest rates that may be coming in the future. We're looking at what it is today, and today is at a pretty much a high. And so we're also seeing low vacancy across our portfolio as well. So one of the things we'll talk about later on is housing affordability being at an all-time low. And when housing affordability and single family continues to drop, it drives rents and drives demand for our apartments. Right now, we're seeing a huge rent to own gap. We talk a lot about that in our marketing pieces, where you see the cost to rent is significantly cheaper than the cost to own a home. We're seeing rates for single family homes between 7 and 8% right now. A year and a half ago, it was half that. So quite different. We are also seeing an increase of supply. We're seeing pretty much record high inventory growth as far as units being built, not only in our markets, but also just across the country. So what that is also causing is slower absorption rates, but what it results in is continued low vacancy. So the supply that we are absorbing currently, while it's slowly getting absorbed, once you get absorbed and stabilized, you're still at 5% or less vacancy. And that's what we're seeing across our portfolio and across our competitors' portfolios as well. Construction financing is also becoming difficult. We're seeing a lot of banks underwrite at much more strict loan to costs, meaning they're requiring more equity in the deal. A lot of sponsors didn't raise enough equity for deals. That's why you'll see a lot of us talk about in our deals and in our projects, a lot of equity. We also build that equity and then we borrow from the bank when we're ready for it. So we get all the way through, framing or put a roof on a project before we're borrowing from a bank. So those are kind of some of the things that we're seeing right now. We're starting to see labor and supply costs settle out a little bit. There was a lot of supply that hit the market in 21, 22, and the start of 23. But now we're starting to see laborers start to, there's not 10 projects to bid on right now. There's maybe 1 or 2. So that usually becomes more competitive pricing for bids. Supply, we have seen inflation. Everyone knows inflation was last year at pretty much at a lifetime high. Now it's 3% higher than the 9% it was last year. So supply costs have started to come down with just the decrease in demand. But the reality is that inflation is also hitting supply as well, because inflation hits pretty much everything. So those are just a few things we're seeing. If anybody has any questions on those specifically, we're happy to address. So this is a graph. We follow a lot of economists in multifamily and in real estate nationwide. We're only in the northwest part of the United States, but we like to follow the whole domestic market because the whole domestic market will affect our market. And so this graph just kind of shows those rent to income ratios and the differences between them right now. And you can see the incomes are starting to come up, and that's what we've seen as inflation hits wages, and we're starting to see wage growth really be real, because employers are having to pay their employees more because it costs more. And rent is also going up with that as well. And rent is also forced by that affordability in housing as well. So that's what we're seeing right now as far as that difference. And you'll hear a lot of us talk about that rent to own gap. And this just kind of briefly touches on that on a domestic market level.
Yeah, one of my favorite things about that last chart is that, when you're doing a rent up, most property managers are required to have 3 times whatever the rental amount is to qualify. So even at 23%, it just shows you that multifamily housing is still affordable to the average household income. So that shows you as well as we actually have room to grow on most of the rents in the US. So with houses being more and more unaffordable, you can see where rents are going to go.
Exactly. One more thing I wanted to add to that too is I think right now across our whole portfolio, we have a project that we will break that mark, the $2,000 mark, but everything in our portfolio right now is under $2,000 a month. Our Ben project will reach that. Our project in Redmond, Oregon, we currently own. We went from marketing at $1,800 a month. Now we're over $2,000 again because the supply in Redmond, Oregon has gone down. And so we're starting to see rent growth again. And so you see those in specific markets. Once that supply and demand balance starts to come together, you see rent growth again because of inflation, wage growth, and housing affordability for single family homes.
All righty, next chart there, Sarah. All right, so this chart is going to show you the amount of construction financing out there. So back in March 22, you see most projects weren't delayed because of construction financing. Less than 10% were. Today, over 60% of construction projects are delayed indefinitely due to construction financing, basically meaning that interest rates have gone up, so their DSCR to achieve the 1.25 means you have to bring more equity to the table. Instead of it being an 80-20 loan, a lot of times you need 40% equity. And a lot of these sponsors, a lot of these groups don't have the financing to do that. And so what this is leading to is as soon as we fill up the current supply over the next 2 years, let's say 24, 25, 26, and 27 are going to be low supply years again, which means all the rents are going to be driven up because people just can't build right now because they don't have the equity, they can't get the financing, and people are a little skittish right now. Awesome. So risks for investors to be aware of in today's market. Let's jump into that. So you guys have probably been following the Wall Street Journal or the Real Deal, but these are a lot of the headliners that have gone around lately. The big one is the Nightingale. Over $60 million basically disappeared. A sponsor, had this promised project and it never went to fruition, but the money went into certain people's bank accounts and who knows where it went. It's still obviously under legislation and they're figuring that out. You have, Appleway losing a $200+ million portfolio and investors wanting their money back. And more and more projects are coming up that people are losing their money on. Investors are losing their money. And what it all comes down to is having a trusted sponsor that you can talk to, that you have the same core values with, and that you believe in their business model. But number two is leverage. You go back to understanding leverage. So like the Appleway development, they were an 80-20 loan on it with floating rate debt. And so when that debt went up, their payment went over what they were collecting in cash. And so they lost it to the bank. I mean, who wants to buy, own an asset that's not cash flowing? And so that's something that a lot of the investors need to understand is that you need to understand leverage on a deal and you need to understand the sponsorship group. One thing that's nice about our group is we looked at 2021 and we realized that that market was fake. I mean, with these record low interest rates, with the amount of money that was put into the economy, we knew that that market wasn't going to last forever. And so we fixed our construction financing. We had, all the way up until earlier this year, we still had construction financing fixed at under 4% on a deal because we fixed it. Because we knew that the floating rate debt wasn't going to last forever. It wasn't going to be a good thing moving forward. We also raised 40% equity on our deals or more sometimes. So we know that we're never in an over leveraged position and we've never lost a deal. We've never lost any of our investors' money. So those are little things that we do to protect our investors and what we'll continue to do as we get bigger projects and do more deals. All righty. So syndication red flag. Sarah's going to go over this. She talks to a lot of the investors, so she gets to see a lot of deals and compare a lot of deals.
Yeah. So I'm really investor facing. I have a lot of conversations with investors that have, shopped around with multiple syndicators. They've been, kind of scared out of investing into syndications or invested period right now in today's market. And so here's just some of the things that I hear a lot that investors are seeing. And one of those are unrealistic returns and specifically significantly different or higher returns compared to competitors in the industry. A lot of the big players, a lot of the main syndicators, we're all relatively seeing similar things. We're seeing similar, building costs, acquisition costs, all of those kind of things are very similar across the board. And so if you see any kind of opportunity with just way out of the ballpark returns and over-promising returns, with really vague reasons as to why. So, they aren't really clear as to, well, that's just, that particular market or things like that, where they just don't really give you a solid reason as to why that they're making those things. I would definitely begin to question their underwriting process. Things like for us, we can sometimes offer things with a little bit higher returns. We get a lot of questions on that, hey, all these other syndicators, compared to all the other syndicators, your guys' returns look a little higher. That's because we offer higher investor splits. So we offer an 85-15 investor split compared to industry standard 70-30. I've seen some with 67-33. So we just have different splits. That's why sometimes our splits can look a little higher, returns can look a little different. You can see preferred returns versus pro rata returns. So all those things can be a little different. So I just always encourage investors to ask a lot of questions to your sponsorship group. Hey, where are you getting these returns from? How are you underwriting? And if they are different, if it looks like a good opportunity, really be clear as to why you're seeing those returns. Another one is inexperienced sponsorship group. There's a couple of us young bucks on this call, but we've got a lot of as we like to say, gray hairs in the mix as well. Yeah, there you go. We got Tom with the gray hairs. John Senior, our CEO, he's not on, and we've got our other regional partner, Jesse Egan. Combined with all of our general partners, we have over 100 years of investor and sponsorship group experience. So we have a lot of general partners in our markets, in the thick of it. They know our group, they know our markets, and they have a lot of experience through multiple cycles. I think that's also really, really, really important. I know Tom, Jesse, and John all have been in different markets over multiple market cycles, and having a lot of experience seeing 2008 and all of these different things. I think making sure you have a sponsor that has that experience is really critical. Also sparse communication from general partners. A lot of times in those headlines, you'll see people will say, I just never heard from them again. I wired them my money. I sent them my check and I never heard from them again. I don't know what happened. That's a big red flag, obviously. It's really, really important to have clear and consistent communication from your general partners and your ownership group. I think, us at Cornerstone, if we're in construction, we'll send at least quarterly, usually every 6 to 8 weeks, construction updates. Once we're cash flowing, we'll send monthly updates. John S., you are actually kind of the front man on that. He will send out monthly updates and even, rent rolls and things like that. We're being super transparent at general partners is important. And I think if you're shopping for any kind of investment opportunity, I think asking and being clear on what are your communication standards and how often can I expect to hear from you, and even during your investment process, how often are you hearing back from them? What's that look like? And then our last 2 points are really underwriting specific. So big things that syndicators will do is underwrite at unrealistic interest rates. They'll underwrite at yesterday's interest rates or old interest rates and be a little bit on the rose-colored glasses part of interest rates. I think it's important to be really realistic and oftentimes, maybe underwrite a little higher with interest rates and things like that to be really, really sure that even if our interest rates changed or were higher, this deal still pencils. And then also underwriting, predicting future lease rates and not today's lease rates. A lot of times, especially if you're a new development or you're doing any kind of value add, you will, investors or syndicators will underwrite on what they expect their rents to be once the value add's completed or the project is built. And oftentimes, markets can change and all of a sudden they underwrote, assuming a 5% rental increase by the time it was hitting the market. And that's just not the way it is. The market changed, all of a sudden it's not looking like that, and rents changed, and all of a sudden it's not cash flowing the way that they promised. And so I think making sure, all syndicators will tell you, we underwrite very conservatively, and I don't think it is a bad idea as investors to, really, really press your sponsor on, what are you underwriting at? What are your interest rates? What are you underwriting for appreciation, for rental growth, et cetera, et cetera. So.
Awesome. Thank you, Sarah. Yeah, we actually underwrite at Fannie Mae standards, which if you guys know Fannie Mae, they're the most conservative institution in the world. If they will accept a deal and give us financing, that means that we are conservative. And another point that I want to jump out is I was actually on a call yesterday with an investor and like, hey, Anthony, I was just talking to an investor. They're promising a 20 to 30% return. Why are you guys not there. And they sent me over the deal, and it's because, you know, again, over leverage. They had an 80-20%, and they're trying to do a merchant development. So basically that means they want to build and sell it. But if they aren't able to sell, if the market looks any worse than it does today and they have to refinance it, they won't have the equity to do so. So they'll have to do a capital call, and that return quickly goes down and your hold period quickly goes up. So just understand what you are investing for and what the underwriting looks like, because it can really make or break a deal. And that's what we're seeing today. We're seeing a lot of deals that were underwritten conservatively as they would pitch it. And look at today, they're now losing to the bank, and that 20-30% return is now zero. You don't even get your original investment back. So that's tough. So, all righty, now we're going to jump into the frequently asked questions that we get asked. We're on a lot of investor calls. I'm on investor calls every day. I know Sarah is, and we are constantly meeting with investors. So we're going to jump into that now. All right, John is going to take this one off. So why do we continue to invest in a multifamily?
Yeah, so this is kind of a simple one to start with. We've got some more specific ones later on. We always like to touch on this one because it's a simple question that we get asked all the time. Hey, I'm looking at, single family. I'm looking at not office, but industrial or retail, whatever it is. Why would I pick multifamily? So here's a few reasons why. Downside protection. You can see there's definitely a better advantage of investing in multifamily even over the S&P 500. And the big reason is appreciation. That's a big one for us, and why investors typically win in multifamily is the appreciation. If you look at what values were in 94 for multifamily or any apartment building, really anywhere, versus today, I can tell you it's a lot different.
That's
the tax benefits, that's my favorite, honestly. I love the tax benefits of multifamily and real estate in general. We're incentivized by the government to build housing because the government doesn't do a good job at it and doesn't do it for a living like we do. And so they give tax benefits to us as operators, but also we can pass those tax benefits to our limited partners. And that's a great part about investing in real estate. And my favorite reason why, with depreciation and things like that, a lot of our investors, we sent millions of dollars of depreciation back to our limited partners this year. So they all got to have some nice tax benefits from 2022 for some projects we finished. Cash flow, obviously a big one. We deliver monthly returns. And so people are getting checks on our cash flowing assets every month. So that's a big one. And then just being invested in real estate, being invested in something that's a hard asset, sticks and bricks, not a piece of paper, not a company, a real asset. So when people say to me, how do I know my investment is secure? How do I know my investment is sound? I say, well, your investment goes right into real estate. It goes into our account. That account is specifically set up for that deal. We don't have mixed accounts. We don't have, a fund that we, go to. A lot of other syndicators do these big funds that's still invested in secured by real estate, but ours are single asset deals. So, the advantage of that is when you put money with us, that money is going into that deal and that deal only. And so just those are some of the reasons why I always answer, this is why we like multifamily.
Awesome. And now we're going to jump into why are we developing in Bend, Oregon? That's probably the biggest question that we get asked, and in Oregon in general. And Tom here has lived in Bend for quite a while, has developed hundreds of properties, has invested his own personal assets here. And so, Tom, why are we investing in Oregon?
Well, they're not making any more dirt. And that's a harsh reality, but with our land use laws in Oregon are the strictest in the United States, meaning that we can't just build things where we want. It's all dictated by a 20 or a 40-year urban growth boundary plan. So basically, they're trying to push growth internally to keep density high and to keep market like grasslands and timberlands available for the public and for agriculture use. We love the Central Oregon area because it's fantastically beautiful. We have some really good employers here between the hospital system. Some really big manufacturers are here. So we have some really great job opportunities here. We've seen some unprecedented growth. I moved here in 1993. There was 35,000 people in Bend. There's well over 100,000 people now. It's not the same city that it was. and that's a good and a bad thing. So they've done some smart growth planning through the urban growth boundaries, but still, it's, you know, it's a big town now. The city is not getting any easier to push new developments through. Um, I've broken my pick a few times here with the city. We get it done, but it just takes a lot longer than other markets that we're in. You know, we have a lot of people who wonder, you know, Oregon is a very, you know, becoming a very liberal state, and they think that when they think of that visual, it's Portland and the homeless, etc. Bend is not like that. We still like Oregon. That's a very centralized issue in the more populated areas. People are flooding to Bend in Central Oregon because of the outdoor activities and the job opportunities. So it's a fantastic place to build. It's a fantastic place to live. And we're still seeing huge demand here. We did have some new tenant landlord laws come in. Some people still can't believe that we can evict people here if they don't pay. That's a for-cause eviction. You can still get that done with no problem. And then we have issues with increasing rents and some caps on increasing rents. And essentially, for any development, if someone moves out, you can raise the rents 7% plus the CPI or consumer price index with a cap of 10. So if it's 7% and CPI is 3, you're at your cap. But you know, I mean, I'd take a 10% increase in rents every year on our
Absolutely.
projects, no problem. Can't always get that, however. When we do new construction, you know, we go to market with market rate rents, and we do increase those as needed. So we stay on top of our market rents, so we're never behind. So does that answer that question for you guys?
Yeah, no, it absolutely does. And I want to hit a couple points there. I mean, if we see a 10% rent growth a year, I think we would all do pretty dang well on an investment. I mean, that would double the asset value every 7 years. That would be incredible because the equity would, you know, about triple every 7 years then, plus cash flow. It'd be a good day for everyone. So another thing is, you know, I always want to point out is people are afraid because it's a blue state, and it is very different than Portland. Bend is gorgeous, A, and B, it scares people developing there, but that breeds massive opportunity, a massive opportunity for returns. There's, you know, smaller amount of, you know, supply coming to these markets compared to like Phoenix, Arizona, Texas, where there's tons of supply. Look at Bend, there's very little supply there. There's very little supply coming. And so it's just pushing rents up. A lot of people are moving there from San Francisco, from Portland, from Seattle, because it's, you know, beautiful there. They can work remote and the quality of life is amazing. I mean, I know it's the 7th fastest predicted growing city in the United States over the next 30 years. So, I mean, it just shows you the population growth there is going to be amazing. And we're, you know, perfectly positioned to take part in that demand.
We're seeing the rent versus own gap just increasingly getting worse, meaning that the median home price in Bend today is $800,000. So when you look at what a payment would be on an $800,000 house, I don't know if we have those stats. I mean, you're looking $5,000-6,000 a month.
Yeah.
And we're typically in the $2,200 to $2,600 a month rental rate.
That's exactly right. I mean, at that payment, you know, with interest rates over 7% today, you're over $5,000 a month if you put 20% down. So you have 160 grand and you get a loan, you're still over $5,000 a month, where a rental is just the obvious choice. And plus, you know, in our location, those houses around our location would be even more expensive because it's such a good location next to the downtown area, next to the old mill district where everyone wants to live. So
You got it.
awesome. Thanks, Tom.
You bet.
Alrighty, let's jump into the other frequently asked questions and some questions that we've been asked leading up to this webinar. So the first one, everyone wants a crystal ball, and I forgot mine at home today, but if I were to say where interest rate's going to go, I wouldn't give a guess because I don't think anyone really knows what Jerome Powell is going to do. We might know more on Friday, but what we are doing is we are fixing rates. So, if you fix your rate, then that debt payment doesn't go up. If the price of the property goes up, your debt payment, everything is still fixed. Cash flow goes up, debt payment stays the same. So we're fixing rates, and if they do increase, we have that underwritten in our pro forma. We're fixing construction loans, we're fixing debt when we do a refinance at the end and give cash back. we're doing fixed rate debt. And if rates go down, as we all hope that they do, we can refinance that. We can increase cash flow, give cash back to our investors, but we are mitigating that risk if it does go up. So that's what I can say about that. What are we seeing with construction costs? So Tom can probably actually speak about this a bit, but I'll tell you what we're seeing. Just actually met with our builder about 2 hours ago, and they're seeing construction costs flatline quite a bit. You know, some materials are going up. Lumber certainly has gone down significantly, but the big thing that everything's hindering on is the labor and labor costs, and really what those margins owners are taking in the subcontracting businesses. And they think that there's going to be some leeway in that, and there's some negotiation in that. So, Tom, you want to talk a little bit more about where you're seeing construction costs?
Sure. We're actively bidding a project here in Bend that's 42 units, and I'm seeing bids wildly different from each other. So same specs, one might be $200,000 or $300,000 more than the other for exactly the same trade. And so what we're seeing is, you know, it's shocking. If you have the manpower and you're good at what you do, you can keep your margins normal and do well in this market. And we love those subcontractors, especially ones we've used in the past. People from out of town are coming in and trying to take advantage of the market, and they're overbidding, and it's really evident now. Whereas 2 years ago, you would just take a bid because you had to.
Right.
You know, you didn't have any options. We couldn't get people to bid things. I mean, we couldn't get refrigerators. Now everything's becoming available. So we're seeing those costs stay steady and not just be, you know, crazy increases on a monthly basis, which is great. So we can predict our construction costs from today pretty much through the construction process. Now I feel confident with that.
That's great. Yeah, we're not seeing the massive increases like we saw in COVID, and we're also not seeing massive decreases. So we think that, you know, they could, if they do go down a little bit, it's going to be temporary, and long term, this is going to be the cheapest time to build, because as labor increases with inflation, it's just going to get more expensive to build. So, you know, when that supply constraint happens in 26, construction costs are going to go up because demand's going to go up. Are people still moving to our markets? I think we just answered that one. Absolutely. I mean, all of our markets, we develop in Idaho, Montana, Oregon. We're positioned to be in these fast growing markets for a reason. There's still people moving to Coeur d'Alene area where I live. There's tons of people moving to Bend. You know, all of our markets are still growing, even with, you know, housing prices going up. I mean, especially in both these markets, home prices are going up and interest rates are going up. So that just shows you the demand is still there for our markets. And there's still people honestly selling their houses in California and moving to these markets. They're still, you know, selling it for 1.2 down there and buying it for 800,000 in Bend and pocketing some cash. So what is our competitive advantage? So, you know, another way to ask this is, why choose us instead of a competitor? Why choose us over another syndication company? And couple of reasons is, you know, first, our core values. We, you know, firmly believe in our product. We are investing alongside of our investors on every single deal. We've been doing this for a long time. Our CEO, John, he's been doing this for over 33 years. Tom's been doing it in Oregon for almost 30 years now. Those are a couple of our competitive advantages, but also we're not over leveraging our deals. We are putting good risk mitigated debt on our property that's going to cash flow, that's going to appreciate, and we are passing it on to our investors. And then, you know, just the last little bit there, our splits are very favorable. You know, we're in the growth mode. We want to, you know, we're raising equity at scale. We're developing at scale. And so for that, we're passing on better splits to our investors. So we want to grow quicker and we want to do more projects. And so that's why we're doing it. And our splits are some of the best that I've ever seen in the industry. So we want to keep that going, and we want to be your go-to investment company and your go-to development company. Anything to add there, John Jr.?
Yeah, I wanted to add, you know, a competitive advantage aside from what he talked about was just locations. We are very focused on the right locations. And if you look at our portfolio and you look at different properties, you know, we follow retailers like Walmart. You know, where's Walmart at in our markets? We want to be within a mile of them. So a lot of our projects you'll hear us talk about, we're right next to one of our projects we're building right now is right across the street from Walmart. Another project, you know, just about 200 yards from our office here in Coeur d'Alene is right next door to our largest employer in our county, which is the hospital.
Right.
And or in Bend, Oregon, you know, we're less than a mile away from the old mill district where everyone wants to, hang out. It's where the river is, shopping, dining, things like that. So, while we may not have the biggest properties in the world, you see a lot of properties that are over 100 units. Our product is a little bit smaller, anywhere from, 13 to 80 units. But we're doing infill projects, and we try to find the best locations, because if anybody here has rented an apartment, if you're going to rent an apartment, it's worth it to live in an apartment because it's usually in a really good location.
Right.
And so we've taken that, and that's been our core business model.
Right. I mean, 100% to that point. We drive higher rents due to our locations. We love the infill stuff. You can walk across the street and be at your job, and it drives higher returns for our investors. And just at a bigger macro scale, I mean, just the markets we're in, Coeur d'Alene, Missoula, all over Montana. There's not a company that's syndicating and developing in these markets at scale like we are. So you can't go out there and find another company that's developing as many units as we are in Coeur d'Alene and in Montana. So that's the other thing, is if you want to be in these markets, but you can't afford to build your own, 40, 100 unit, 150 unit project, then you can work with us, and we'll manage it and we'll develop it, and you can invest in these communities at scale. So why would I invest in real estate over treasuries right now? I mean, that's probably one of the biggest questions, and it's currently our biggest competitor. And just goes down to opportunity cost. I mean, treasuries, sure, you might be seeing a 5% rate right now, but let's say you lock that for 5 years. Do you honestly think interest rates are going to be where they are in 5 years? So now when you go reinvest that dollar, you're probably not going to be able to replace the cash flow with anything much better that's that risk-free. And now you miss 5 years of appreciation and opportunity costs. So even if you're seeing 5%, most of our investments are offering about a 15 to 18+% average annual return, meaning we're about 3 times higher. But sure, your month-to-month cash flow might be 5, 6, 7%, might be equal to a treasury, but it's the appreciation and the tax benefits that really build your wealth over time. I mean, if let's say we have 65% debt on a property, that property goes up by 3% due to inflation, you're seeing a 9% increase of your overall equity plus the cash flow. Well, there's your 15, 16, 17% return. So still in all, our returns are far higher than a treasury, and you'd be missing out on the opportunity cost with investing in treasuries over real estate. Last question that we have on this is, why would a tenant choose our community versus living somewhere else? And I think we kind of hit on that with John's point, but we choose the best locations. We try to choose a Class A location, build a Class B product, and get Class A rents. So we're building a good product. We're not doing ultra luxury. We're not doing ultra tile everywhere, but we're building a great product. We're delivering a product that's equivalent to a first-time home buyer's house in these markets. Quartz countertops, stainless appliances, LVP, but nothing too fancy. But our locations sell themselves. If you want to live across the street from the hospital in Coeur d'Alene, we own the closest apartment to the hospital. If you want to live, a mile from the Mill District, but not pay Mill District rents, you can live a mile away and rent our apartment that's on the Deschutes River Canal, have these beautiful views of the mountains. And so that's why they are choosing our markets. And we've proven in other markets. We have projects in Post Falls, Coeur d'Alene, Montana, that we're proving this with already. I mean, our vacancy rates are low and our demand is high on all of our products because it's the same philosophy we use over and over and over.
I want to add one thing to that too. I think one of the reasons too, from my end of the spectrum is management. And the key to real estate, this is one of our favorite mentors says this, the key to real estate is property management. And for me, working with managers every day, working with the right managers is really important to us. And so in each of our markets, we've carefully selected the right property managers. We don't currently do property management in-house. We contract it to the local property management companies here. And the reason why we do that is because the managers that we work with manage thousands of units. So they know exactly what tenants want, and they know how to meet those needs of those tenants. And so at each of our properties, if we have an on-site manager or if we have someone that's doing leasing for us, they know what tenants are looking for, and they offer very good service. So we heavily not heavily overmanage, but heavily work with our managers to make sure they're providing the best community possible. And that's one of those really small differences that you'll see on those red flags too. How are the managers managing the managers of those assets? Because if your tenants aren't happy, they don't want to pay the rent on time and they want to leave. And so our job is to not only take care of our investors, but also take care of our tenants, because this is where they live. It's a very, their home is very important to them. We want them to stay. That's important to us. So that's just one last thing.
Right. And with that point, why we do a lot of development is because we get to cater our product to the modern renter needs. We have electric chargers, we have, space for offices and desks, we have nice spacious kitchens. We get to design these to meet what the current demographics looking for. Whereas, value add or old construction doesn't get a cater in the way we do. So again, it's kind of just a win-win situation, and it just drives down our vacancy and increases returns to our investors. And we're proving it over and over again. All righty, well, that is the end of the webinar. Sarah, you can take it off on the communication page. If you guys have any questions, comments, concerns, you guys can reach out to us. We've got a contact page here at the end.
Yeah, and Anthony, I think we've got a little bit of time. We have some live questions coming in. I think that we'd love to just tackle and address right away. I think we've got about 5 to 10 if you guys are good with that.
Perfect. Yeah.
Are you able to see these questions?
Yeah, I just saw them. I'll read them out and we can answer them as a team here. So first one, is there any investment house like Merrill, JP, et cetera, that has written a reported report on multifamily sector recently? Thanks. Yeah, I mean, we constantly looking at different economists. We work with Bellwether closely on our refinances, so they're constantly sending us stuff. We're happy to send out, what's the one that we get all the time, John, for multifamily housing updates? Do you remember what that one's called? I have it right
Yeah, I don't have it on my desk.
This is actually, it's right here. This is a great one.
There you go.
Institutional Property Advisors. We print it out and we read it like on a weekly basis. So this is this is a great resource. I'd highly recommend subscribing to their newsletter. I mean, house prices, heating back up type idea. It has everything on housing, rentals. That's one that I would highly recommend if you guys want to understand what's going on in the multifamily sector, because it's important to stay engaged and stay up to date with what's going on. All right, the next question. What term debt do you get when you are fixing debt? At what price these days? That's question number one. So, I'll speak to a recent project. That's the easiest way. So we're doing a 68 unit project in Missoula, Montana, right next to a super Walmart, great location, next to restaurants, again, a good infill location. We fixed that debt for, was it 30 months, John? At 6.75% construction financing with the option to fix it for 3 more years after that if we don't want to quite refinance it yet with Fannie Mae. And then when we do refinance it, we're going to go for either a 5, 7, or 10-year fixed rate interest only with Fannie Mae. We like that product because they're A, super conservative, and B, we can give back more cash flow to our investors than if we were paying down the mortgage. We've proven it time and time again. We'd rather give our investors tax-free wealth than have phantom income by paying down a mortgage.
I want to add to that too, because he asked in here as well, the 42 unit project that was described, what was the price per square foot on the construction costs?
That's right.
What build to cost do you underwrite? So I think he's referring to the current offering we have in Bend.
Yeah, that is our current offering. So that's Bridgewater Apartment Homes. We are about 70% subscribed on that deal. We have a lot of interest around it. We have our first permit. So we underwrote that, was it, Tom, at about $195 per square foot. And our projections are coming in about right at target there currently. So, we have some contingency baked in with that, and we have some overall reserves as well baked into that. So ideally we can overperform. But rates, we predicted that 6-8 months ago, and it's still about the same price.
It is. It's a struggle, but we're literally going line item by line item right now, and hammering price where we need to. And then we're coming in, just slightly over right now, but we're just getting started on the value proposition on this deal. So we're getting close.
Yeah. And what build to cost cap do you underwrite? So, we are wanting to build around that 7 cap range. Ideally, if we can overperform that, we want to be at over a 7 cap. in Bend right now. I actually talked to our property manager, and there is a project selling in Bend near this project right now at a 5 cap. So I know that rates are high, but you still have these larger institutions who want to be in these markets, who are okay with, paying 50% equity and only seeing a 3, 4, 5% cash on cash return. So in these markets, we're still trading at 5.5 cap on lease stabilized, good location assets. And this project actually is very close to Bridgewater, selling right now at a 5 cap. So I'll have more details on that actually in the next couple of weeks. If you spend $3 million on a project, what ARV do you target? That's a tough question because every single project is going to vary. That's going to vary between state. That's going to vary between asset class. We want to see, average returns in that 15 to 18%. That's kind of our targeted in today's environment at today's rates. So that's what I can say there. We always want to overperform, but we're also very realistic with our expectations. $3 million projects, so honestly, a little bit small for us. We're getting to the, 15 to $40 million range. Sometimes higher is what we're aiming for in most of our projects today.
I can touch on that one as too.
Yeah.
So the way I understand ARV would be after repair value. And so that would be, I have actually an example of the one that we mentioned earlier, right across the street from the hospital. The budget was, I think between 2 and 3 million for the renovation. So if you spent about that much, what value do we target? It's a good question. When we're looking at value of a property after we're going to be putting our renovations into it, I guess my answer would be the value would be based on what we're going to be renting it for. And so one of the things we're doing in a project like this is we're going to furnish 6 units. And so the value of this project, we're just doing this right now, but so it's kind of not super specific, but it's an example, would be the value of this project is going to go up quite a bit because we're going to be furnishing units for healthcare employees. And so we'd like to see a value far exceed what we originally projected. When we first started this project a year ago, we actually underwrote our rents between $1,400 and $1,600. And now our property manager just gave us rents we're going to be marketing for this project because we're just about finished with it. And we're actually starting at $1,600 and our furnished apartments are going to go for $2,500. So nice. Value is really kind of a tough thing to say because value would be kind of more like, hey, we're going out to market to sell it. We're not a company that likes to build and sell projects immediately. So I would say value would be, far and above what we originally projected.
Right.
But that's kind of just an example of what we're doing today.
Right. And I can talk about, we have another project that we are finishing up the lease up on in Missoula, 54 units we built for 11 million. And our predicted value today is just over 15 million. So we built that one quite a bit under what the market value is. And the same with this Bridgewater one. We're building in the $14 million range. And if we, had it finished leased up today and we could sell it, our property manager estimates to be worth just north of 18 million. So that kind of gives you the idea there. And that's all based on today's rents, of course. All right, next question. How concerned are investors with negative leverage? If they are, for how long are they willing to stomach until you can increase yield to a positive position? I would say that, look outside of the investors, we're not willing to take on negative leverage. That's just too much risk even for ourselves as general partners. We just don't want negative leverage. These 5 cap deals, sure, they're trading. That doesn't mean we're buying them. That's why we're still, still developing that 7.5 plus cap range. That's why we haven't bought much value add in the last, year and a half, unless we bought one and it was just a sweet deal right across the street from the hospital there. But most investors aren't willing to stomach a negative cash flow when they can put it in treasuries and get positive cash flow, and not negative leverage. So we just don't see it very often. We want to develop at a 7.5 cap, and we can still get, Fannie Mae. We just did a refinance at just under 6%, and that was for 10 years, so not negative leverage. So we just don't put ourselves in a position to do negative leverage. And again, we wouldn't put our investors in a position to get negative leverage. We wouldn't recommend it. Too much risk, not enough return.
Quickly on that one, We all, as a team at Cornerstone, invest in every single project. I invest for future cash flow. I am no way going to take a negative leverage position. There's just no way. I won't do it.
Right. I mean, there's really no indicator on how long these interest rates are going to stay up, and if they could increase more. And there's just no telltale sign of how long this could be. This could change next year. This could change in 3 years. This could change in 5 years. And so, if you want to have negative leverage for that long, when you can choose not negative leverage, I'm not sure why you would. What are your splits? Our splits are, so we have a pretty conservative and a very simple split structure. So we're 85-15 on all cash flow, tax benefits, depreciation, refinance, everything, 85-15. The only way that changes is when we sell the product. So let's say Bridgewater. So we're going to sell that in 5 to 7 years. And we only give you, that split changes to 70-30, but only on the back end. So, and only when we're giving you back 100% of your capital account back. So if we sell Bridgewater, let's say in 5 years, we've given you back 50% of your capital account. Well, then when we sell it, that equity then at the back end is split 85-15 still until we give you back 100% of your capital account. And then it's split 70-30. So all of our metrics, all of our returns have all of that included into it. So that, the 2x equity multiple, the IRRs, all of that is included with our splits. So industry standard is 70-30. And, you have IRR hurdles of, I'm just seeing one the other day of a 15% IRR hurdle. We have no hurdles. We have nothing like that. It's just a straight up split. And that's why most of our investors see a significantly higher return than other syndicators. I want to start a syndication in my market. How do I start? That's a tough question. So that is probably a question for another time. There's a lot that goes into a syndication. You could reach out to us probably privately, and I could be happy to help point you in the right direction, but you're going to need attorneys, you're going to need structure, you're going to need a lot of legal documents to get you started on that journey and a deep understanding of how to do it.
I would just want to add something to that too, because if I were to start this over again and I were to start this, let's say just by myself, I would start with data. I would start with, start with apartments.com. I'm on apartments.com every day. Look at what rents are. Look at what other amenities or other apartment communities are offering. Look at median home prices. Go drive your market. One of the things that all of us do, we get in our cars and drive. We love to just go look around, just get obsessed with the idea of real estate and start with that. Start with falling in love with, your local market, wherever you want to invest in, and identify your location. That's one of the things, when we have Tom in Oregon. I was actually born in Oregon. So was my sister, Sarah, or in Coeur d'Alene. Anthony's born and raised here, and we moved here, but we've fallen in love with our market here, and we know our market well. So that's just the one little tip I would say is just know your market.
Great point there. And the last point here, Tom brings up, Berkadia has a great monthly family report as well as CoStar. Tom's a big real estate investor, big developer. He is a top of his class. So anything he says, I would definitely highly recommend as well. So I would definitely check out both of those reports, and we'll add them to our list as well. So I think unless I missed anything, Sarah, I think that's it.
Yeah, thanks everybody for joining us. We really appreciate your time. Feel free to reach out to us. I know that we may not have gotten to everybody's questions, so feel free to reach out to us. My contact information as well as Anthony's contact information is on there. So you have our emails, our phone numbers. We also have a live chat option on our website. So if you miss any of this info, we will be sending this out with the recorded version of this. So you'll see our info and anything like that. Feel free to go to our website, our email, social media. We're kind of everywhere. We're usually pretty quick on responses. So feel free to reach out. Happy to answer any questions you have on what we discussed today or investing.
Super quick. Well, we got one more in, and they wanted to describe the splits again. So let me try to explain it in just as simple as I can. So we do an 85-15 split on all cash flow, tax benefits, refinances. So what that means is if we're, if we're cash flowing $100,000 a month, we pass on $85,000 to our investors, and that never changes. As those rents go up, that never changes. If we appreciate the asset, 85% go to our LPs. If we do anything, it's 85-15 split to our investors. And the only time that that changes is when we sell an asset. So when we sell an asset, if we have paid back 100% of your capital account, then it's a 70-30 split. But if we haven't, again, if we've only paid back 50% on the back end and we sell it, it's still an 85-15 split until we give you back 100% of your capital. So that way we make you even, and then say that there's double the equity than your capital account, then we'll double your money with the 70-30 split. So that's how that works. But during the asset, management, during the cash flow period, it's an 85-15 split, no IRR hurdles, no cash flow hurdles, nothing like that. We just like to make it straight and easy and very profitable to our investors. We give the majority of our profits to the investors. So that's
Awesome.
that understands it. If there's more questions around that, reach out to me, email me, call me, happy to answer them.
I think
Thanks,
that's it. Thanks, panel. I think that was super helpful. Again, feel free to reach out to us, anybody, and we're happy to answer any more questions. Other than that, I think we'll call it a night.
Awesome. Thanks, guys.
Sounds
Thank
good,
you.
guys. See ya.